Okay, hello everybody in Facebook land. Welcome to the second episode of What's Going On in the Housing Market due to the coronavirus. So today I have Dino from California Coastal Loans, and he's going to talk about a little bit of the loan side, what's going on, what has changed, what you need to know about when you are starting to apply for these loans to make sure you have a successful sale and you can hopefully get through the whole process without any issues coming up. So with that, I'm going to kind of get right into it with Dino. So one of the first questions that I'm hearing a lot about is what has really changed recently and how people are qualifying for loans in terms of either FHA or standard loans, and what people need to be looking at when they're trying to apply for these loans.
Josh, I got to tell you, before I start answering the questions, we got to have a little bit of fun, right, with the whole coronavirus. You got to do what you can. So I appreciate you doing all these videos and giving some good content out. And I just wanted to do my very best to do my Josh impersonation. So
That should be good.
I cut the hair down.
There you go.
The beard, but I couldn't do it in a couple of days. But check this out.
Beautiful. Perfect. There we go.
Okay.
It's like I'm talking to myself right now.
All right. So what was your question again?
So basically, I wanted to try to figure out what has changed recently in the last couple of weeks in terms of how people are going to qualify for loans, in terms of restrictions, different things with credit scores, not only with standard loans, but things like the FHA loan as well, because I know a lot of those have been changing recently and getting a little bit more strict on who can qualify for them and how they get qualified for them.
Sure, for sure. So a couple things. One, if I can start just kind of with a little bit of a background of what's happening, and I know everybody knows, but just kind of a little bit more in debt to the actual happenings at the bank that people don't realize. So here's basically, in a nutshell, we saw the lowest levels of interest rates we had ever seen about a month ago. All right, they were going on for a short period of time, and during that period of time, literally, like, every single person had an opportunity to refinance. So the amount of volume that was going on was just unprecedented. It was beyond control, So the banks all got bombarded with so much volume, they had a heck of a time keeping up. So as soon as that started happening, they basically started raising the interest rates artificially just a little bit so they can start slowing things down. Okay. And if you imagine, how many loans they were funding out, and just for even numbers, let's just say one of them has a credit line of 100 million, even though it's in the billions, but let's just say it's a $100 million credit line. They fund out all these loans, and then all of a sudden their credit line is down to very little. So what do? They go sell these loans, and then they replenish their credit line, and then they keep funding new ones, and that's how they stay in business. Well, everything was working just fine up until the stock market crashed. And when the stock market crashed, then all of a sudden they didn't have this ability to sell the loans, so they couldn't replenish their credit lines, and they couldn't keep up. And then what happened there is that they ended up having these big, huge margin calls, tens of millions of dollars, and a lot of them couldn't come up with it. So a lot of them ended up going out of business, or really putting themselves in a situation where they had to tone it back big time. Otherwise, they were going to be totally out of money. And that kind of kick-started everything. And then the president came out, said, we're lowering the interest rates to 0%. Everybody literally thought that meant interest rates were 0%, which it had nothing to do with interest rates. But what he did do that was huge is he said, we are going to jump back in and help you guys, and we are going to buy mortgage-backed securities. And that basically guaranteed the banks a place to sell these loans. And all of a sudden that freed up a lot of money, and it kind of put them back in business. But the non-QM loans, which is basically like the bank statement loans, all of those had no more outlet. So they got stuck holding all these loans, because when the government said we're going to buy mortgage-backed securities, they meant like Fannie Mae, Freddie Mac type loans. All of the other stuff doesn't count. So almost every single non-QM bank all went out of business. A lot of the jumbo stuff also just got discontinued. All of the creative stuff got discontinued. So that changed the market drastically, and a lot of people couldn't end up closing on the loan that they were in because of that. So then the coronavirus happens, and everything just got 5 times worse than what it was, because now these banks had funded all these loans and they're going to sell them to Fannie Mae, right? So they can get their money back, but they find out that all these people have lost their jobs. So now they can't sell these loans, and now they're stuck. And all of it just, just came on top, one on top of the other, and created a massive issue for the banks. And now to boot, there's all these forbearance agreements that are going into place, which means they're not going to get any money for 3 months. so they're really hurting right now. And I do want to talk about the forbearance agreement just quickly, because everybody thinks that it's fantastic news. Don't have to make a payment for 3 months or whatever it is, and life is going to be great. And I will admit that there are some banks that are doing a true forbearance the way the individual sees it, and that is they're being given a choice. You can either pay it all back when the 3 months is up. We can do a payment agreement to kind of pay it off later, or we can just throw it onto the back of the loan. Throwing it onto the back of the loan is truly the best case scenario, and you're cool. But that's not how the majority are doing it, and nobody realizes that the majority of the times when that 3 months is up, you're going to owe 4 months. Your next month's mortgage payment is due, plus the 3 months that you didn't have to pay. And then you're going to be in a world of you know what, because you're going to be stuck with these huge payments. So be very cautious before you accept any forbearance agreements. And if they're not going to throw it all on at the back of the loan, then just consider making your payment, right? At the end of the day, I think you'll be better off. So all of that said, that's caused the banks significant financial problems. And then they also can't work from the office. So they're sitting there relocating thousands of people to work from home with very sensitive information, which is a nightmare and a half to deal with. So that's kind of what kickstarted the whole thing that a lot of people don't realize. And everybody thinks these interest rates are so ridiculously low. And in all fairness, they should be. They should be less than 3% right now, but they're not, because the banks just can't handle anymore, both capacity-wise with the amount of employees working from home, also capacity-wise with their big warehouse lines and what they can actually fund out, and more importantly, what they can sell so they can replenish their money. And that's kind of where we're at right now. So what's happened is the majority of the banks have all of a sudden tightened up on their guidelines. And they basically turned around and said, hey, we don't want to fund this loan unless we know for sure it's going to be a good loan. How are we going to do that? Well, we're going to be ultra conservative. So I'll give you an example. As a debt ratio, we were typically able to go up to 50%, no problem whatsoever. Now 43%. Now there's a lot of misinformation, and I'll tell you, one of the largest wholesale banks in the United States that we use all the time, they threw on, we call them overlays, a stack of overlays onto their loans that said 43% debt ratio, unless you have, I think it's 12 months reserves. If you're a first-time home buyer, you got to have not only your down payment and closing costs, but now you got to have 6 months reserves. If you're self-employed, they're going to take 25% off of your income right out of the gate, unless you have 12 months reserves. And reserves to a bank is whatever your principal, interest, taxes, insurance, and HOA is. Whatever all that is, times it by 6 or by 12, depending on the program. And if you don't have that much money left in the bank after all said and done, then they're not gonna take it. Now that's just this one bank, and because they're so huge, it's affected a lot of people that are in the middle of a transaction with them. But there's other banks that are not requiring that, and they're still going off of old traditional guidelines. So the advantage, I think, like for what I do for a living, is I'm a mortgage broker, and because I'm a broker, I'm not tied to any one bank. I'm capable of shopping per se. Like I can go to any of these banks, and in some cases, we go solely after rate, but in other cases, especially now, we go after who can fund this deal. And all of a sudden, the rate's not as big of a deal as it is funding it, getting it to go through. So that's the real big one. So to answer your question, there's a lot of changes that have happened, but there's also no changes that have happened at certain banks. And it's function, knowing how to navigate through those waters. And so another piece of advice to everybody listening is, if you're in the process of doing all this, you have to have a good loan officer that is working on your file. And the reason why is because first, and I'm a little prejudiced just because I am a broker, but if you go to a broker, you'll have more options. And it's not you that has to know all your options, it's him. He or she will end up knowing how to navigate through those waters, right? But then you got to pick the right mortgage broker, because in today's climate, there's so many changes happening at all times, like every single day, actually, that if you don't have a guy who's totally on it, you're potentially not going to get the best deal.
Got it. And I've definitely been seeing that a lot. On your end, have you seen a lot of deals kind of falling apart in the middle of escrow because these things have changed? Or on your end, if they're locked into something and you're kind of halfway through escrow, are you seeing most of these close at that point?
It's interesting, Josh. Up until now, the majority of the deals that were in escrow when all of this happened, all canceled.
Okay.
The vast majority of them canceled. But at the same time, in the last week or so, we've put a whole bunch into escrow, and every single one of them was multiple counteroffers, and in some cases above asking. So, at the end of the day, I think before this pandemic started, our economy was strong and our real estate market was extremely strong. So there was a lot of fear that happened. So a lot of people canceled, but didn't take long. Everybody's right back at it again, and they're feeling like maybe they can even get a better deal in some cases. And I think what's happening is you're seeing both. It's been a seller's market for so long that there's been no flexibility on the seller side, and all of a sudden it's like everybody's cordial, everybody's being nice to each other and allowing flexibility because we need it, as a group here. So I'll tell you where the biggest obstacle is right now, and that's verification of employment. So, normally you have your W-2, you have your pay stub, and you work there. Well, then we have to get a written verification of employment that validates all those numbers you've given us on your pay stub and W-2 and all that, and that you're still working there. And there's a little box that says likelihood of continued employment. Excellent, maybe, bad. Those are both negative things, right, that the lender is now going to really look at. But then right before loan docs, these banks do a verbal verification of employment, and they have to call the employer to verbally hear, yes, he or she's still working here, and yes, he or she is expected to keep working.
Got it.
That process has become a total nightmare, because let's face it, every one of those people that verbally validate aren't at the office working anymore.
Yep.
And there's a lot of people still in the middle of refinancing, so they're getting bombarded with HR stuff galore right now, which is turning into a problem. And then a lot of the banks, they do that right before, all of them do it right before they produce loan documents. But then a lot of the banks right now are actually doing it one more time right before they actually fund the loan, because they don't want the person to have lost their job in that few days in between the two. So that's been our biggest obstacle right now. But to be honest, just to answer your initial question, it really isn't that much different, other than you have to just navigate through so many different obstacles to get there. And the underwriters are being a little bit tougher all the way around, just making sure that everything's going to be okay. And a lot of that has to do with, a lot of the things that you guys don't see behind the scenes is just that everybody's working from home. I mean, I'm not, I'm still at the office, but the underwriters, the processors, the escrow officers, the title rep, I mean, everybody's working from home. There's very few people that have this set up at home that they do at the office. They just can't work at 100% unless they do.
Yeah, I can definitely attest to that with 2 children running around all the time. So, okay, yeah. And then, so during escrow, I mean, that sounds like the only big thing that has changed on your end. I know from talking to people as well, the appraisal process, as well as seeing it, a lot of those are starting to move towards the drive-by appraisals where they're going out to the property, taking pictures, but not actually going inside to keep everybody a little bit safer. Are you seeing that continue to ramp up, or is that kind of evened out to where it is right now?
Yeah, no, that's a good question. So that's starting to happen a lot. Even before all this happened, they had started something called an appraisal waiver, and we never knew if we were going to get it or not. But once we run it through the system, it spits the answer out and it says appraisal waiver accepted, and that means that Fannie Mae is cool with what the value is and what your equity position is, and they're like, we don't need an appraisal. We're good with it. And I think what's happening now is they're starting to do even more of those, and that'll allow for, the nice thing too is it's less time in processing or an underwriting, so it goes a little bit smoother. It's a little bit cheaper for the client. It just moves everything along. If an appraisal is needed, a lot of the banks are doing what we call desktop appraisals. So they'll actually have an appraiser. Which is what they typically do anyway, is an appraiser knows what the value of the house is almost every single time before they even go out to see it. They look at the pictures on MLS or Zillow even to see what it looks like. They've done all of their comp work on the back end, and they already have a predetermined number in their head. They're just going there to take pictures, take a couple measurements, and oftentimes they don't even do that anymore because it's in every other database somewhere else, right? Unless you've done an addition. So now what they're doing is they're just doing more of that. And I'll tell you one thing too, there's like a pilot program that we're in that's kind of cool, and it's just started, so we haven't even done one yet, but they're actually going to have either the realtor or the buyer or seller or the owner of the house, whoever, if it's a refinance, walk through with their camera and do a 360 view of each room and go through, is there granite, is there hardwood floors, is there, whatever the situation is, and start doing, alternative methods.
Okay, well, that's good to know. And then one more thing on the appraisal side, have you seen, I know you kind of said it was more of, you kind of put everything in the system and then figure out in the back end if it's going to be a desktop or something like that. Have you seen one type of home qualify for those desktop appraisals more often than others, like a lower price or certain price points, certain areas, or is it just kind of at almost random at this point?
Yeah, I mean, owner occupied is getting more of them than non-owner occupied. Term refinancing, meaning you're not trying to pull any cash out, is getting them a lot more often. Cash out typically doesn't. And also, the overall package, right? I mean, if you, when you buy the house and get an appraisal, even when you do a refinance, these appraisals for the last several years, they get logged into the Fannie Mae database. And let's just say it appraised a year ago for $700,000. And now you're saying it's $710,000. There's algorithms that they use behind the scenes, and it's like, okay, well, in general, appreciation has been X amount. Since a year ago, this thing came in at 700. It's very likely that number of 710 is accurate now. So we're good. We don't need an appraisal. Versus if you haven't done an appraisal in, let's say you haven't done a loan in 7 or 8, 9, 10 years, and all of a sudden you're doing one, there's nothing really in the database that they can relate it to. So I don't think their algorithms are intelligent enough to be like, in a matter of seconds, figure out what that house is worth and spit it all back. So houses that have done financing in the last, couple of years have a better chance also.
Okay. And then, so that's pretty much, that covers most of escrow. And then is there anything, I know a lot of these changes, it seems like a lot of these changes took effect right around maybe 2-ish weeks ago now at this point. And that's when you were kind of saying everything was dropping out of escrow. And now that these new procedures and processes are in place, we're starting to see a lot more getting back into escrow because it's kind of settled down a little bit. And like you were saying as well, on my end, I'm also seeing a lot of, especially on the under $1 million homes, still getting multiple offers on them. and still having a lot of people interested in the property. So I mean, it seems like even though supply has been going down as well as demand has been going down, it's been going down pretty similarly across the board. So it's keeping the market healthy right now, and it looks like it's going to be continuing to go that way from what I'm seeing in the data points right now, at least for the foreseeable future. Is there anything that you're seeing on your end in terms of the data that you wanted to talk about on the lending side of things?
Yeah, for sure. Listen, nobody has a crystal ball. Everything is just an opinion. And at some point, either somebody gets lucky or things actually work out the way they thought it would. And I've been doing this for 21 years now, and I'm definitely no analyst, and I go a little bit more off gut instinct. And quite honestly, my gut instinct says we're going to be just fine. And okay. I think, our economy was booming a month ago. Our real estate market was off the charts, but at a healthy level, and I think as soon as all this is over, at least like you said, in the under $1 million range, I have zero doubt that we're going to be in good shape. I have a bunch of slides that I kind of put together to show everybody, but before we go to that, the only thing that could change, and it's going to be crucial, is the next 30 days. How bad is it going to be, or how much better is it going to be? Because if things get worse and people truly lose their jobs for good, as opposed to, hey, I got to lay you off, but as soon as we open again, you got your job back, then I can see things going bad. If true foreclosure starts happening, what people don't realize is there's a couple things. One, it may not be as bad because people have a lot of equity in their house right now. So if foreclosure had to happen, I would have to think that most people would be like, hey, let's just sell. We can still walk away with $100 or $200 grand. It's better than losing a house, right? So I think that in general could end up being a pretty good thing for people. And that's only if they get laid off and can't find a job again. But gosh, our economy was booming so much so that I would have to think it's going to be okay. So I put together some slides just to kind of show everybody. Should I share my screen, or are you gonna?
Yeah, sure, go for it.
Okay, so everybody see it here?
Yep, looks good.
So on this first one, if we look at the annual home price appreciation, prior, like before, everybody always thinks of 2008 and what happened, how bad and how severe that crash was. And the thing is, that was a one-time thing, at least in our lifetime, right? It wasn't so, it was horrible, but everything else hasn't been so bad. And if we look at the appreciation, the 6 years leading up to the big crash, we had these monster numbers of here, 12.5%, 11.4% appreciation. I mean, that's monster. Over the last 6 years, it's been just slow and steady. In fact, the last couple of years have declined, but still a very healthy number, which I love. I love seeing that. And then if we go here, back then, everybody was buying and selling homes. I mean, everybody was a master real estate mogul, master flipper. Now we don't have a lot of homes. And I'll tell you some of the numbers that why I think that happens as well. The whole millennial age group, it's such a massive population that, and all of those people are coming into market right now where they can, they're working, they're of age, they're getting married, they're having kids, they're buying homes. It's just kind of the natural progression. And in Orange County alone, we have something like 80,000 potential first-time home buyers every year entering the market. The statistics show that in order to meet that demand, we have to have about 30,000 new homes being built a year. And we only have 10,000 new homes being built every year. So just think of, supply and demand. I mean, that's, that says we have a shortage of houses. So chances are we're going to be okay. And then let's look at this next slide. So this is back pre-2008. I mean, every single loan I did was cash out. Everybody was taking cash out of their house. And if you look at, 321 billion, 240 billion. I mean, those are massive numbers of people taking money out of their house. Here was the norm. Do a refinance. I'm going to lower my payment because the rates were low, and I'm going to pull some cash out. And life is going to be great. I'm going to have X amount of money in the bank. My payments are low. And I don't have any debt. And then about 8 or 9, 10 months, 12 months later, they had a brand new pool. They had a brand new boat. They had a new car, and they had $30,000 in credit card bills. So sure enough, they'd come back. Hey, Dino, I need to get a refinance. Pay off all this debt. Might as well pull out another, 50 grand while I'm at it, so I can have a nice little nest egg again. And it was just ongoing. It was insane. Yeah. But when your appreciation's going up 10+%, I guess you kept having that money to pull. So, but versus now, let's look at this. Barely, they're not pulling as much money out of their house. People are more equity rich than they used to be. All right. Actually, let's go to this next slide here. So I love this slide. It goes along with what my prediction is, but here we are right now, right? We just finished up the first quarter and everything was great, but we saw this massive decline because of the coronavirus. And if all my predictions come true, then, and this is actually following this to a T, we're going to start coming out of it and constantly going up. So over the next 3 to 6 months, I see nothing but positive news coming. Again, unless in the next 30 days, this coronavirus does not get under control and it becomes worse, right? Then everything could go south on us. But along with that, if things do start getting better, I can see a lot of pressure on the banks to lower those interest rates. I can also see everything kind of going back to normal where they can offload the loans and feel comfortable doing it. Everybody's back at work, so they're not getting stuck with these loans, and interest rates dropping, for the first time to under 3% consistently. And I think, imagine how awesome that would be after all these people kind of got displaced here over the last 30 days and you're not sure what's going on, and then they're able to refinance at under 3%. They're good after that, they're really good.
Yep.
Did you have a question?
No.
Okay.
It's all great information.
And then this one is really interesting too. So everybody thinks that during a recession that the home values drop significantly and everything goes bad. And the reality is in 2008, we got hammered on every sector across the board, right? And as you can see, it dropped 19.7%. And this is the home prices, right? I mean, that's significant.
Yeah.
Prior to that, the recession, values actually went up. Prior to that, at 1.9, I can take that. It's pretty much stagnant. And then all the other ones, they actually went up. And the reason why they went up, because during recessions, interest rates typically drop. So if interest rates are dropping, then the natural thing to happen is for people either to start buying houses or to refinance, and it pulls them through. So even like now, we're officially in a recession, but it's really not that bad. So anyways, that's it.
Got it. Agreed. That's similar to what I'm seeing. It seems like we were having actually a decent amount of appreciation, probably one of the best years we've had in a while at the beginning of this year before everything really started dragging down at the end of March. And it seems like even if we lose 1% or 2% of appreciation, which again, especially under $1 million right now, we're still having properties with multiple offers and going at the very high end or even above asking price and market value in a lot of cases. That, at most we might be losing 1% or 2% for the next month or two, and then after that, the rest of the year it looks like it's going to be making that back up plus some. And I think at the end we'll be coming out of this with probably anywhere from that 3 to 5% appreciation, which is kind of like we've been hitting for most of the last couple of years, like you were just showing as well. And that's kind of what I'm seeing as well with the numbers. So. Anything else that you want to share about the lending side of things? You've already given us a wealth of information already, but anything else before I let you go?
Yeah, just to anybody that's interested in refinancing or buying a home, if you want to jump in and do it right now, chances are you can and everything's going to be fine. choose the right person to work with. It's going to be very important. I'm a bigger fan of choosing a broker, because a broker has several options instead of just one. And so that's important right now. It's really important, because even the big banks are experiencing some pain. And then the other thing is, the process in itself, even when everything is wonderful, is difficult enough. So go into it, being very flexible and giving grace to everybody involved, because there's a lot of people involved in doing a refinance or purchasing a house, and everybody's struggling right now, and everybody's having to kind of overcome the typical issues. So, don't go into it with a hard attitude, and just be open-minded and flexible and forgiving and, workable. It'll go a long way, because right now it is frustrating for us. And when clients are frustrating, to be honest with you, we'd rather just not work with them right now. It's hard enough.
Yeah.
So that's all.
Okay, perfect. Well, again, I appreciate you coming on, because this has been a lot of great information, especially on the load side of things. So hopefully we can do this again sometime and see what's going on another 2 weeks or so. But again, I appreciate you coming on, and I think that should be wrapping us up. If you do have any other questions for Dino, his contact information, let me throw it on the screen really fast again. So you can reach him right there, and he'll be able to help you out. And then if you do have any questions you want to leave down in the comments, he can answer those as well if you want. So again, thanks for tuning in, and we'll see you again shortly with a new update. Bye.
Awesome. Thanks, guys. Bye.